Welcome to the daily update, where I'll go over the action in the market for Tuesday, February 13th, and then we'll see how things look for Wednesday, February 14th. Happy Valentine's Day. Well, the market saw a pretty significant decline, at least compared to what we've been seeing lately. The CPI report came in hot. We've had an overextended market to the upside for quite some time. Sentiment was quite extreme positive. The report came in a lot hotter than expected, and a lot of folks decided to do some selling. For right now, it looks like a pullback, but we'll keep watching it as things unfold to see if this is going to develop into something that lasts longer. We are coming into a period of seasonality where historically, when the current president is running for re-election, where we tend to see some weakness in about the middle part of February that can go into the middle to latter part of March. Some other research suggests that it might be from the middle of February to the beginning of March. You can look at all kinds of different statistics, but the one that I've been looking at as a guide does suggest that historically, this might be starting of a weaker time. We'll have to see how things hold up during that time. So let's go back and talk about what happened. The futures were already negative before the CPI report came out, so there was some weakness already building up. Then once the report came out, we really shifted lower. So we had a massive gap lower, especially compared to what we've been seeing lately as far as movement. Prices fell below S3 at 49.66. So now we're back under 5,000. We tried to find support at around the 49.50 level, but we couldn't get much above S3. Things just kind of stalled out and then started to go lower again. We fell back below S3. We went all the way down below S4 at 49.34. We finally found support at 49.25, another kind of round number there. We rebounded up and we did see some buying going into the close. We closed just a little bit above 49.50. We were down 1.37% and we did pick up to above average with volume. We're still looking positive with our technicals, but we're showing some weakness now. There are some things that we've been watching for quite a while that could be starting to come into play. And everything had to do with the CPI report that came out, which showed inflation. It's still looking okay on a year-over-year basis, but on a month-over-month basis, it was stronger than expected. And that's going to influence what the Fed does with interest rates. Of course, we have all the different geopolitical events that at any time could come in and really have some kind of an impact. Some comments were back below 5,000 with the S&P 500. We did see more broad-based selling due to the stronger than expected CPI that came out. Small caps were very weak. They just got hammered. And this has to do with growth concerns because smaller companies, they typically need to borrow more. And when interest rates are higher, that's going to bleed into their earnings. We also saw some more weakness in the regional banks. Our list is now just showing the stochastics being extreme positive. And that's because we have three different charts on that one page that we look at. And it takes a little longer for all of these to work off an extreme reading. Also, we're looking a little bit oversold already, believe it or not. With the VIX based on 9 periods, we look at that using the RSI 9, and that's already getting to an extreme positive reading. The Stochh RSI, which was extreme positive after Monday, now it's already extreme negative. We only have our oscillators that we're really keeping an eye on. A lot of the other intermediate term indicators, they're a little bit near being extreme positive, but they're starting to come down. We don't have any long-term indicators right now. The 150 and the 200 period moving average studies, those have now dropped down and they're no longer extreme positive. But this next one is a big one. The parabolic SAR now has a dot on top. Personally, this is one of the more important indicators that I follow, and the fact that this has switched over negative. Now, it doesn't mean it's going to stay negative, but the longer that the dots stay on top, the more that could bleed into more of the intermediate term trend. We still have the same basic scenario. The big variable right now is, okay, the Fed's probably done raising rates. They're probably going to cut rates, but when? That's the variable. It had been March, that was taken away. Now we're looking at May, that's even looking doubtful now. So the market has to kind of play this game of trying to figure out when are the rates going to happen. I saw anywhere from 6 to 8 rate cuts, depending on who you read, what you look at. That's what the market was expecting. The reality might be 2 to 3, and even that is in question if some of these economic reports end up coming in stronger than expected consistently. The dollar was up and interest rates were also up. This has been a concern too that the market was pretty much ignoring with the 10-year yield. We're up to 4.32%. And that's getting pretty high. And this is starting to really bite into stock market gains because what they had been ignoring, now they're having to pay attention to. We still have the yield curves that we've been following that are inverted. We were extreme positive with sentiment. We were above that 75 level. With the down day, we've dropped to 69. But the context is a bit different here. We are positive, but we're coming from extreme positive down to positive as we have been declining. Our trend is still positive, but we're getting weaker because the ADX is dropping below the moving average again. The green line is still on top, both with the short and intermediate term chart, but that could change if we see some more follow through weakness. With the down day, our bias is negative, and I've switched our momentum from mixed to negative where it had been positive. The reports that came out, one that really didn't get a lot of attention was the NFIB Small Business Optimism. That came in at 89.9, where last time it was at 91.9. This was the big one. CPI, they expected it to come in up 0.2%. It came in up 0.3%. That's the headline number. Last time it did come in up 0.2%. This is the inflation part that the market really fixated on. They expected it to be up 0.3%. It came in up 0.4%. Last time it was up 0.3%. So here's a chart. First looking at business optimism, where it really dropped off from a recently high reading that we saw last time. Here is the year over year for CPI. Now, when you look at it year over year, we're still declining. The blue line is going down. That's the total. And the core, which measures inflation, that's the yellow line. That's also continuing to decline. It's the month over month figures that really spook the market. Then when you look at services and commodities year over year, we're starting to turn back up when we look at services and you take out energy, where the commodities are continuing to drop off. So on a year-over-year basis, this is still looking okay. Then we look at the CPI with the chart. We go back and look at the 12-month rate of change, where we're still declining that way. But we did tick up when we look at the month-over-month change. Also with the core, we continue to decline, where we're going back up with the month-over-month change there. I don't have any Isabel Net blog charts. There didn't seem to be any that really fit where we're at right now. Here's our intraday chart where we really gapped down below S1, below S2. We opened below S3. We came down to about this 49.50 area. We tried to bounce up and get back above S3, but that just wasn't happening. So then we fell back down. We came all the way down to S4, fell through that, came down to 49.25, another round number. And this is a bit encouraging. We saw some pretty healthy buying going into the close to get us well up off of the lows for the session and close at about the 49.50 level. Here's our intraday chart, where in the initial overnight session, we were trailing off just a little bit. We were also going a little bit lower in the pre-market session. Then the report came out. That's when the weakness really hit. We see the weakness that we saw in the cash session, and we're pretty much flat in the initial overnight session here. This is encouraging. We can still take this as positive for right now. The blue line is above the red line. They were both down, and these are measured independently of each other, and they're on different scales, but it's more positive when we see the blue line above the red line, and that's still continuing. Here's the ratio. This is also encouraging for right now when we compare growth to value. Even though it got hit early, it started to make a comeback, and we closed pretty much unchanged here. So to have a pretty solid down day and to see this virtually unchanged, I'm taking that as positive for right now. We want to see what's going to happen going forward from here. Are we going to start to go back up, or now are we going to start to see some weakness? Here's our end of day charts where everything was red. The middle area, these are the ETFs for the large, mid, and small caps, where we had large cap growth was down compared to large cap value, and they were about even with the large caps. It was down less with the mid caps, and even though the small caps just got hammered, small cap growth was down less than small cap value. So we ticked up a little bit when we look at our growth to value ratio for the small caps. This is still hanging in there for right now. We're not seeing it in the index, but this is showing that there's potentially some strength under the surface. We did come down a little bit, but we're still hanging in there when we look at mid-cap growth to mid-cap value. And we actually ticked up just a little bit when we look at S&P growth to value here. So far, this is still holding together. Looking at discretionary versus staples, we did come down a little bit with the ratio after we had been showing some improvement. We did see this negative divergence that I've really been talking about, but then it looked like things were starting to break out here. We'll have to see, is this going to follow through with more weakness, or are we going to be able to turn and go back up? Keeping an eye on the trend, we're dropping below the moving average with our intermediate term chart. The green line is on top, but it is declining. I was also trying to point out here that we were getting above 40 with the green line. That was showing a pretty extreme reading there. Also in the short term, we had got above 40 with the green line. We're dropping below the moving average, and the red line is starting to come up. Even though we were above average with volume, the last number of days we've been decreasing with volume. Keeping an eye on sentiment, we ticked up just a little bit with the Ulcer Index, but not a real big move there. This is the VIX using the RSI based on 9 periods where we're starting to get extreme positive. That means that we just shot up pretty fast compared to what we've been doing lately. So when we look at the VIX of the line chart, that really went up, and the VIX of the bar chart. Now, when you look at the bar chart, we closed in about the middle. So we were well off the high for the VIX. We also saw the VIX of the VIX really shoot up here with the bar chart and close in about the middle. When we look at the line chart, which is the closing value, that also shot up. We did go up with the equity put call ratio on the daily chart, but we're still declining with the 5 period, looking at the equity put call ratio. This is a chart I've been trying to highlight lately, the VIX to S&P 500 correlation. We did spike up and we're starting to come back down. Typically, that's negative when you look at these red lines and see what the S&P did after that. So far, that seems to be playing out. When we look at the SKU index, we're still up in this red area. This hasn't necessarily completed what it's trying to tell us, meaning that there still could be more to come. Again, we're not really sure if this is going to be more of an up move or a down move from here. But based on the VIX, based on the other studies that we look at, you might want to at least default to the negative side for right now. When we look at this fear gauge, we are starting to go back up, showing fear is increasing. The advanced decline line's hanging in there for right now. We turn down based on price and volume. If there's a negative here, it's that volume is going down quicker than price. We're rolling over a bit with the 5 period new high, new low study, but we're not really seeing an expansion of the new lows. We're seeing more of a contraction of the new highs. We're also going down with the 10 period moving average. We declined, but we're still above 0 with the advanced decline ratio. And the cumulative advanced decline line for the NYSE, I brought this up in yesterday's video because it was really breaking to the upside. And that's the way these cumulative charts act. They can be really spastic. And so with the down day, this is really going down. But when you look at the regular NYSE advanced decline line, yeah, it declined, but it's not necessarily falling apart at this point. Accumulation distribution is still hanging in there above the advancing moving average. The Chaikin money flow also is not showing an awful lot of weakness, at least yet. We did come off of being an extreme positive with the Chaikin oscillator. We came down with the NYSE advanced decline line, but so far we're still in a longer term uptrend there. So we came down with our advanced decline line studies. When we look at the common stock for the NYSE, we're still holding up a little better with the S&P, a little bit more weakness with the mid caps, and we're coming back down to the moving average with the small caps. Here's the chart, and it's really hard to see. We came down to this trend line that I just put on here before Tuesday's video. I have another breakout chart to show you. On the bottom, we did come above average there. And on a one-day basis, we might have overdone it. When we look at the percent advanced decline line for the S&P, we are extreme negative. Also, when you look at the one-day rate of change, we're also possibly extreme negative. Now, with both of these charts, the previous one and then this one, it doesn't necessarily mean we're going to stop and go the other way. It just might mean that we're going to slow down, or that we might have overdone it. You can go back and look at other times when we had these readings. Sometimes it didn't necessarily mean a real bounce out of this. This is what we're keeping an eye on for right now. And so far, this is encouraging. we fell all the way down to the 20-period moving average, and that acted as support. The blue line is the exponential moving average. As long as we can stay above this, this will probably signal that we're just having a short-term decline. If we break below this and then close below this, that's the important part, then this could suggest that we're seeing a little bit more weakness, and then we would start to look at the 50-period moving average after that. Here's the mini rainbow here, also showing that we came down to the top end of the lines that are plotted on this chart. We were extreme positive with the Stochc RSI. Now we're extreme negative. All the other indicators haven't generated any kind of an extreme reading yet. And I was incorrect in yesterday's video when I look at the 20, 50, and 200 period moving average study. This is not looking internally at the S&P. This is just measuring the S&P itself. We have other studies that we look at that kind of dive under the surface. But we did see some weakness across the board with these moving averages. We're coming back down right about to the midpoint here with the force index. And when we look at the stochastics, we're no longer extreme in the short term. We're coming down and just barely extreme in the intermediate term. We're rolling over, but still extreme positive in the long term. We're right on the border between the +1 and +2 standard deviations channel here, so we're no longer extreme there. The balance of power actually ticked up just a little bit, and we're above the midpoint, so that's still positive. We went from being a dark blue to a lighter shade of blue with the go, no-go system, so that's positive with more of a neutral to negative stance there. We did fall with the highest high value, but we're coming back down to the midpoint. The TTM squeeze is turning more to a darker shade of blue. That is still positive, but could be showing some weakness. And on a one-day basis with the ease of movement, we just fell through the floor here. When we look at our 14 period, it is also starting to go down, but it's still above zero. The Erin coming down just slightly, no longer extreme positive there. And we were showing some improvement with the McClellan oscillator. Now we've dropped back below zero. We've also been focusing on this longer-term negative divergence as the S&P has been going up. So we continue to decline with the summation index based on price, and we're turning back down based on volume. We dropped below zero with the NYSE McClellan oscillator, so that's turning more negative. So we're going back down with the summation index for the NYSE based on price. We haven't quite rolled over yet. It's really hard to see right there with the summation index based on volume. We did turn down with the Swenlin trading oscillator, but we're still above zero when we look at price and volume. Where the PMO, it's still extreme positive, rolling over a little bit, but still above its moving average. When we look a little bit deeper, we're still below the moving average based on price, and we're flat based on volume. We did see a decline with the PMOs that are rising. We're turning down with the buy signals, and now we're seeing more of a sustained decline with the PMOs that are above zero. And even with the big downward move, we went from being neutral after Monday to still being neutral after Tuesday with the Elders Impulse system for the S&P. This is a big one. It might be a little hard to see, but now there's a dot above current price here. The parabolic SAR is either positive or negative. It has been positive for a while now. With the dot on top, it's now turning to negative. We're rolling over below the moving average with the slope oscillator. We're also coming down, but not quite below the moving average with the MACD. So in the short term, we're rolling over, but still extreme positive with our short-term oscillators. We are rolling over a bit, but not quite below the moving averages in the intermediate term. Longer term, with the TRIX and KST, we're still looking more positive. And this is another look at the 20-period moving averages. We're going to be watching this level, which is at about the 49.09 to 49.10 level here. And then the bullish percent index is continuing to decline. That's more negative, but we're still above 50. We're also declining here with the NYSE bullish percent index, but also still above 50. The NASDAQ 100 bullish percent index, for the first time since November, we finally dropped below 70. This is officially a sell signal. We are declining, but we're still above 50. So yeah, if we continue to go down here, that would be more negative. But the fact that we're still above 50 could also be taken as positive. We're no longer extreme positive with the money flow index. Also, the ultimate oscillator is declining. The vortex is coming down with the green line, but we're still positive there. And I wanted to show this, that we're with the Bollinger Bands, we've come down just about to the midpoint with the support level. We closed up off of that, but this is another area that we didn't quite get there, but we tried to hit that throughout the session, and that support level so far has held. We're no longer extreme with the RSI based on 14 and 9 periods. We're still positive, even though we declined with the on-balance volume. And we were seeing longer-term negativity here with our 200-period moving average study. And these are the stocks inside of the S&P, the ones that are above or below their 200-day moving average study and then 50-period moving average study, where we did decline here, and we're seeing more of a pronounced decline on the bottom area of the chart. We're crossing over negative with the Copic curve. We're no longer extreme. We're right on the border with the Sean trend meter. We're looking a little more negative with the Heiken Ashi. Still looking positive, but we're pointing down with the Kegi chart. The Renko chart has not redrawn yet. It's still looking positive, seeing some weakness here with the 3-line break. Long term, this is the trend line where we actually broke below it intraday, but we were able to close just a little bit up off of that for right now. This is another area that we're going to be watching. So this is a little higher up. If we drop down below this, right below this area right here will be the 20-period moving averages. Keeping an eye on our indexes, and this is a new one, and I have a typo here. It should be the Keller trend model. David Keller is associated with stockcharts.com. This was a new thing that was added. I looked at this after Monday's session, and everything on here was green. So we look at the S&P, the mid caps, small caps, and the Qs. Well, after Tuesday's session, we have the mid caps and the small caps turning negative in the short term. Then also I wanted to include the alerts that are triggered. Almost everything with the exception of the healthcare was red in Tuesday's session. We saw both the equal weight and the S&P really down in Tuesday's session. We came down just a little bit with our ratio, and the Dow is still above this pivot point right here. So it hasn't really broken below support, at least yet. But we have switched from being positive over to negative. When we look at the diamonds for the Elder's Impulse system, we're just a little bit below this R1 level. When we look at the NASDAQ, we did break below this level when we look at the NASDAQ 100, but we still remain neutral with the QQQs with the Elder's Impulse system. And we're just about on the moving average and possibly dropping below when we look at the PPO or the momentum for the NASDAQ 100. And this is the small caps. They've really been a source of frustration. We saw a couple of really solid days getting up to this R1 level, and then they were down over 3.5% in Tuesday's session, and they're starting to break below their 50-day moving average again. They've gone from being positive over to negative with the Elder's Impulse system for the small caps. And we did get above this resistance level for a couple of days. Now we're dropping back below it, and we're back down to the 50-day moving average. And we also saw some weakness with the mid caps, but we're still above this pivot level. We're still above the 50-day moving average. But we've gone from being positive with the mid caps over to negative with the Elder's Impulse system. We did not set a new all-time high. I think that's pretty fair to say when we look at the FANG index, but it's still hanging in there for right now. The financial sector was down 1.33%, but still is in an uptrend. And we're keeping an eye on New York Community Bank. The regional banks got hit pretty hard. It had been rebounding back up. Then it saw a real decline on Tuesday again. The dollar's been really rebounding since the latter part of 2023. It's getting up into the 104 range. It's still in a longer-term downtrend. If we can stay above both of these lines, we might see a golden cross here. We really shot up with the 10-year based on yield. We came down with the 10-year based on price. We're back down to the 200-day moving average. We're declining with the RSI. Momentum is also declining. And then looking at growth to value, not an awful lot of damage here. The Qs to S&P were coming down to the moving average. We've already been weak with discretionary to the S&P. That came back up to the moving average, and now it's turning down. We saw a little bit of a turn down when we compare large cap growth to large cap value, but it's still above an advancing moving average. So we saw a little bit of weakness with the large caps, mid caps, and not an awful lot of weakness with the small caps. A little bit of a positive thing to hang on to for now. We're still positive when we look at the moving averages of the highs minus the lows across the broad market. So what's our outlook then for Wednesday? We're still positive technically for right now. And it looks at this point as though we're pulling back after we have been overbought. But we want to keep an eye on this idea that is weakness starting to develop. Are we going to see more follow through with that? Or are these shorter term support levels going to hold? We're going to get the MBA mortgage applications index in Wednesday's session. We want to keep an eye on the different geopolitical events. In Thursday's session, we have a whole list of economic reports. The biggest one's going to be retail sales. And then on Friday, we're going to get PPI. Seasonally, when you look at February 14th, we're neutral to positive with the Dow. We're also straight up positive with the S&P and NASDAQ. So we have that going for us. We tend to be a little bit more positive than negative during the options expiration week, which is what we're in right now. When January is up, this tends to be good, but maybe we've gotten a little far above this rise here. We see that a little bit more pronounced on this next chart. The orange line is what has typically happened. The green line is what's actually been happening. And even if we stay positive, we might be diverting back to this more normal price range. And we do see some weakness possibly here with the Stock Traders Almanac statistics. This is the one that I've been honing in on the most. When the current president supposedly is running for re-election, we see some strength until about the middle part of February. This is about where we're at now, where we see some weakness going into the latter part of February. We might get a bounce in March and then possibly some more weakness to the middle to latter part of March. February ends up being the weakest of the strongest 6 months. And Wednesday tends to be the most negative day of the week, according to what happened in 2023. We do see a little bit of weakness here when we look at the green dashed line. That'll be the 10th trading day of the month. This is the S&P during an election year. So our scenario's not really going with the downwind yet. We're still looking fairly positive. We'll only go back to looking more positive if we see some strength, if we can bounce up off of some support and actually close up and see some technical improvement. We're not going with the sideways trend right now. Even though we're dropping below the moving averages, the ADX indicators themselves are still above 20. So volume has been decreasing as the S&P has been moving higher. That's what's already happened. We saw volume pick up as it went lower in Tuesday's session. If we start to go back up, is volume going to become anemic again? We just want to watch for that. The risk on posture has just not been helping us right now. The S&P oscillators, we're positive there, but we're still extreme positive, and now we're starting to drop below the moving averages in the short term, and we're showing some weakness in the intermediate term. The McClellan oscillators and summation indexes are negatively diverging. The parabolic SAR has turned negative. The Coppet curve is negative. The bullish percent index has now dropped below 70 and is declining. And the momentum for the NASDAQ 100 is weakening. Small and mid-cap growth is negatively diverging from the S&P, but for right now, it's been holding up. Discretionary is also diverging from the S&P. Transports are negatively diverging from the Dow and S&P, and we are entering a potentially historical seasonal weak time. Positive side, growth is still holding up to this point. Now, that could fall apart at any time, but to see the big downward move that we saw on Tuesday and to see growth holding up, that is encouraging, at least to this point. Our oscillators are positive, but they are showing some weakness in the short term where they're dropping below their moving averages. The equity put call ratio is still going down for right now when we look at the 5 period. The vortex is still positive, but it is declining. Small and mid-cap growth has been holding up so far. The financial sector, even though it declined, is still positive. So our conclusion, we're positive, but we're declining after being overbought. We want to watch for further weakness. That's what we're really watching for in the short term. We're also keeping an eye on that in the intermediate term because we have some indicators that are giving us a little bit of concern. We're still positive in the long term, and we're no longer overbought. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.